Welcome to this question. We're going to start with the reading time, and I'll talk about a couple of things you should have seen, do a little bit of light revision, and then we'll move on to the solution from there. But the majority of the discussion will come from this reading time. So again, please attempt this question before watching the rest of this video. Okay, so let's start. It says this question consists of two unrelated parts, part A and part B. Unrelated means you can do them completely separately, they don't affect each other. Okay, part A. Patrick Bateman is 38 years old. Look at the age, he's younger than 65. Younger than 65, or the age of 65 or older, as you know, there'll be a couple of things that changes. You get extra rebates, your medical payments, section 6B, additional medical credits, that section changes. Some of your exemptions might change, interest exemption, etc. Okay, so always pay attention to the age. Patrick Bateman is 38 years old, is a resident of South Africa. Patrick owns shares in various companies. Some are held as trading stock and some are held as long-term investments. So those which are held as trading stock will be gross income when you sell them. There'll also be trading stock deductions, and the long-term investments are capital in nature. They tell you SARS accepts Patrick's classification of these shares. That means go with what they say in this question. The shares forming part of Patrick's trading portfolio. Trading portfolio is again the gross income amount. All shares listed on the JSE. Patrick owns less than 10% of the issued share capital of these companies. Right, then they give us on the 1st of March 2024, they give us what the shares are. Now, obviously, you'd always have a question for the year that you are in. In this case, the year, and you'll see it also if you look at the solution, would be from the 1st of March 2024 until the 28th of Feb 2025. Okay, so this is when they give us the 1st of March, it means opening stock. Right, they give you the shares as part of his trading portfolio. Now remember, the shares held as part of his trading portfolio are trading stock. So when we have trading stock, any opening stock is a deduction. Any purchases, and that's a deduction under section 22.2. Any purchases is a deduction under section 11A, and then closing stock is added back, section 22.1. Now, usually when we do this, we will use the lower of cost or market value, as you can remember. But you must remember, when it is shares, you only use the cost. Okay, so for shares, we only use the cost. So they give us the shares here on the 1st of March. They tell you the names of the companies, Jasper, Gertha, Floro. They tell you the number of shares that was in the opening stock, the date they were acquired, the cost of the shares, the market value of the shares, and then some further information. So we will use the cost of the shares. Even so, like for example here, the cost is 225, the market value is 205. Usually you would use this thing for opening stock, but because it's a share, you must use the cost. Remember, that's what it tells you in section 22.1. What's also important to remember about trading stock shares. So these are all things that should pop into your mind immediately when you see trading shares held as trading stock. A section 9 capital C will apply, which says that if the shares held more than 3 years, treat as capital in nature when sold. Right, section 9C, if you haven't revised that again, make sure you go and revise that. I'm not going to go in detail to all of the rules there. That's the most important part there. And this is it only applies to trading stock. Right, only to trading stock. If your shares are already held as capital, then you won't look at Section 9C because it is already capital. And remember, what we'll see also when we look at it is that there is Section 9C5, which will apply. Section 9C5 says whatever you claim as a deduction must be added back. Okay, so these costs of the shares is what we're going to claim for our opening stock deduction. Then they give us the shares of his investment portfolio. So this is capital in nature. There's no opening stock, no closing stock like that. It's just base cost. Right, they give us the information. So note number 1 over there is for Jasper. Patrick sold the shares in Jasper at their market value of 208 on the 15th of April 2024. Patrick had received a gross dividend of 12,000 rands from Jasper on the 12th of January. Right, so a gross dividend means it's the amount before dividends tax. So that's the amount that we will include in our tax calculation. It will be exempt under Section 10(1)(k). This is a local dividend and it's not an annuity. Okay, let's now see here. They sold this on the 15th of April 2024 and they bought it on the 1st of August 2020. So the 1st of August 2023 would have been 3 years. As you can see, this is more than 3 years. So it's more than 3 years. So we are going to apply Section 9C to that. Okay, then we have number 2 over there. It's for Gertha. Over here, they say Patrick transferred 4,500 of the Gertha Limited shares from his trading portfolio to his long-term investments. So this is trading stock becoming capital in nature. Usually when you do that, you would have a Section 20(8) recoupment for the trading stock, which means basically you would add back the market value and then the base cost over here would be equal to the market value. However, in this case, this happened on the 1st of August 2024 and this was purchased on the 15th of July 2019. So as you can see, again, we've had these shares for more than 3 years. So I'm going to make the comment here, more than 3 years. Now remember, although you're not disposing of it to someone else, you are treated as if you are disposing of it as trading stock and then buying it back as capital nature. This Section 20(8) is not applicable if Section 9C applies. You will still only apply Section 9C5 here, which means you'll add back the cost and then it's treated as a base cost. Okay, this is a tricky one, guys. They tell you he did not sell any of the shares and they had a market value of 42 rands per share at the end of the year. At that point in time, though, they are all treated as capital in nature. Gertha Limited declared a dividend to shareholders on the 1st of December 2024. Patrick received a net amount of 9,600 in his bank account in respect of this distribution. So there was a gross dividend which was declared to him. Then there was dividends tax withheld on that, 20% of that amount because he is a natural person, and that gave him 9,600. Now remember, just as a quick reminder, the amount that must be included in your taxable income is the gross dividend amount. That is the amount that this person became unconditionally entitled to. The dividends tax is paid afterwards. Right? And I know you might say, yes, but he gets the amount in his bank account net of it. Doesn't matter. At the time when I say you are entitled to a gross dividend or this dividend, it's the gross amount. So this is an application of the Witwatersrand Association of Racing Clubs principle, which said the amount that you are entitled to is yours. Doesn't matter what happens to it afterwards. So remember, guys, you have to say 9,600 times 100 over 80, and that will give you the gross amount. Okay, and then number 3, Floro bought it on the 18th of December 2023, so that's still reasonably new. It says Floro made a distribution to its shareholders on the 19th of June. Patrick received 5,000 in his bank account. 2,000 of this amount is a return of capital by Floro. That's contributed tax capital. So he got 5,000 rands in his bank account. How many of you got this one right? Which is 5,000 in his bank account, and they tell you that consists of 2,000, which is contributed tax capital, and then 3,000 must have been a dividend. But now remember, the same story would have happened. The dividends tax would have been withheld on that 3,000. So that's the net dividend amount. So it would be 3,000 times 100 over 80 would give you the gross amount of 3,750. What do we do with contributed tax capital? Now remember, if you receive contributed tax capital, then the following happens. This is a quick little recap and a reminder. The contributed tax capital, if the shares were trading stock, the contributed tax capital amount is gross income. If the shares were capital, it is capital nature. Now what I mean by that is it depends on how you receive it. You will more than likely apply paragraph 76B, which says you need to reduce the base cost, or it is something like a liquidation where it is a disposal. Now, if what I'm drawing up here, if you go, wow, I don't know what that is, it was the first time I've seen it, you need to go back and study. You've missed out important parts of the work. This is just a reminder. Contributed tax capital, you treat it differently depending on what you receive it for. Because they're held as a trading stock, it will be gross income. Okay, then we have number 4, ASPERS. This is a capital nature, so we don't look at section 9C. It says, Patrick became entitled to a gross distribution of 30,000 from ASPERS, and 8,000 of this is a return of capital. Okay, so now he receives contributed tax capital of 8,000. This is for the capital shares, so the shares were capital. So what are we going to do with it? It's not a liquidation that we're receiving, so we're going to apply paragraph 76B to that. Then Patrick sold 300 of the shares at their market value of 18,000. Right, so that's all of after all of that. Then number 5 is this Jules, purchased 2023, so also fairly new. It says Patrick had purchased the shares in Jules with the intention of holding the shares as a long-term investment. Jules Limited announced that it planned to list on the JSE. On the 1st of April 2024, the company confirmed that it would list on the JSE within a year's time. Patrick decided to transfer the shares in Jules from his investment portfolio to his trading portfolio on the 28th of April, and they had a market value of 90,000 this time. Now remember earlier we had one where trading stock became capital. This is now basically the opposite. This is where capital becomes trading stock. Now, when capital becomes trading stock, paragraph 12 of the H schedule says it's a disposal at market value. The trading stock, section 22.4 says you are treated as if purchased at market value. Then on the 1st of November 2024, so that's after all of that, they performed a share split where each share in issue was split into 10 shares. So if you had 1 share, you now had 10 shares. This was to decrease the market value per share. After the share split, the market value was 190 per share. Now, what happens with a share split? How much do you spend? Nothing. How much do you get? Nothing. You still have the same value of shares. So if you had 1 share which was worth 1,000 rands, and now you have 10 shares, they are worth 100 rands per share. But how much do you still have? You still have 1,000 in value. Okay, so nothing happens. They didn't tell you. They listed, he purchased an extra 150 shares, and then he sold all of his shares at 240 rands per share. Okay, so that is it for this part of the reading.